So we are standing right in the middle of a $1.25 trillion boom in AI infrastructure. I mean, 1.25 trillion.
It's a massive number, yeah.
Right? And while everyone is staring at the tech labs, watching the next large language model write a poem or generate a video.
Which is what grabs the headlines.
Exactly. But the most dangerous and frankly the most fascinating innovation in this entire space isn't happening at NVIDIA or OpenAI. It is happening entirely in the shadows of Wall Street.
And it's utilizing the exact same financial plumbing that brought the global economy to its knees back in 2008.
Yeah. Welcome to the deep dive. We are unpacking a stack of dense, frankly alarming financial and technological reports today. We're looking at Bank for International Settlements research and, crucially, the groundbreaking post-AI quantum framework of Dr. Yogesh Malhotra.
We're really getting into the weeds on collateralized compute obligations, credit default swaps, and why the algorithms Wall Street is using to manage this massive bubble are predictably designed to fail.
So whether you're an investor trying to navigate this new asset class, or you just want to understand the invisible forces shaping the next decade, we are bypassing the hype. We were looking straight at the machinery today.
And to really understand that machinery, you have to look at the sheer velocity of the capital required here. I mean, the hyperscalers, so Microsoft, Google, Meta, Amazon, they are locked in this massive arms race.
Right. They're buying up every chip they can get their hands on.
Yeah, but $1 trillion in capital expenditure, that is a staggering amount of weight to put on a conventional corporate balance sheet. The traditional models of corporate finance have effectively, buckled under the pressure of the AI gold rush.
So they needed a new pipe.
Exactly. They had to build a new pipe.
Because, if you go back 10 years, right? A tech company needs a new data center. They issue some standard corporate bonds. They use their cash flow. They build the building. They buy the servers. Clean, straightforward, on the books.
Very true.
But you're saying the sheer scale of AI has forced the creation of this new pipe, which the industry is calling the Collateralized Compute Obligation, or CCO.
Right, the CCO.
I know you listening are generally familiar with structured finance, but let's look at the mechanics of the CCO specifically. We are literally securitizing compute.
Yes, we are taking the future revenue streams generated by AI compute contracts and turning them into tradable debt today.
Okay, so think of the underlying assets here.
Right. It's not a diversified portfolio of consumer loans. It's racks of high-performance GPUs. It is the long-term lease agreements on the data centers housing them, and it's the cloud compute contracts signed by these AI startups.
Wall Street engineers just bundle these together into an asset-backed security.
Exactly, which inevitably brings us to tranching.
Right, and I want to make sure we trace a dollar through this system properly for everyone. So we have the capital stack split into tiers.
The tranches, yeah. The senior tranche, which gets rated AAA by the agencies, catches the first cash flows.
Then the mezzanine tranches, like A or BBB, sit right in the middle.
And the equity tranche sits at the very bottom, absorbing the first losses, but, commanding the highest yield.
So picture this like a financial waterfall. If you're a pension fund buying that AAA tranche, you're standing at the top of the cliff, catching the first, safest drops of revenue raining down from these AI cloud contracts.
That's a great way to put it.
And the mezzanine guys are halfway down the cliff, taking on more risk for a higher yield. But the equity tranche is standing all the way at the bottom in the mud.
Yeah, they get a massive payout if it rains hard, but if there's a drought, like if AI startup demand dries up, they are the first to get wiped out.
Right, they dry up first.
But let's complicate that solid visualization of the capital stack, because the Bank for International Settlements, the BIS, has flagged a structural dynamic here that is deeply concerning.
Oh yeah, the shadow borrowing.
Exactly, it's what they call shadow borrowing.
I read that phrase in the BIS report, and it implies the debt isn't just structured, it's hidden. How exactly does shadow borrowing work in the context of a massive hyperscaler?
It works through special purpose vehicles, or SPVs. So let's trace your theoretical dollar again. A hyperscaler doesn't actually want a $10 billion loan for GPUs sitting on its main balance sheet, dragging down its return on invested capital metrics.
Because Wall Street would punish their stock price.
Right. So they, or a specialized neo-cloud provider working closely with them, create a legally distinct entity, the SPV.
Right.
And then the SPV goes to the private credit markets, to massive institutional investors, and raises the debt.
So the SPV issues the CCOs.
Correct. The SPV buys the physical GPUs and the data center space. Then the hyperscaler simply signs a multi-year operating lease to rent that compute capacity from the SPV.
Wow. So economically, the hyperscaler is still taking on a massive long-term obligation. But accounting-wise, they've substituted an upfront CapEx hit and on-balance sheet debt for an off-balance sheet operating expense.
Exactly. The risk is legally siloed away from the parent company.
And this isn't a small fringe practice either. I mean, the sources highlight CoreWeave, which is a major specialized GPU cloud provider. They just closed an $8.5 billion debt facility completely backed by GPUs.
And it was rated investment grade.
Right. And they did another $3.1 billion publicly syndicated facility right next to it.
Yeah.
So we are talking about tens of billions of dollars, highly leveraged, hidden in SPVs, backed by microchips.
Which brings us to the inevitable comparison. I mean, you have structured, tranched, asset-backed securities.
Yeah.
You have off-balance sheet legal vehicles. You have yield-hungry investors ignoring underlying asset quality because of AAA ratings.
It's 2008 all over again.
The architectural parallels to the subprime mortgage crisis are undeniable.
Okay, so we have these fragile, highly leveraged structures. But let's push on that parallel for a second. In 2008, the underlying asset of the collateralized debt obligation was a subprime mortgage. The asset was a house. Today, the underlying asset of the CCO is a server rack full of NVIDIA chips. What is the fundamental mechanical difference that makes the CCO potentially more dangerous than the CDO?
The primary difference is what the financial engineers are calling the silicon obsolescence factor, and it changes the math on everything.
The silicon obsolescence factor.
Yeah, let's look at a house in 2008. The homeowner defaults, the bank forecloses, the housing market might be in free fall, prices might drop 40%, sure, but the intrinsic utility of the asset remains.
A three-bedroom house built in 2006 is still a functioning three-bedroom house in 2010.
Exactly. You can rent it out, you can hold it until the macroeconomic environment recovers. It is a durable physical asset.
Right. Even in the worst-case scenario, the bank has a physical property with a floor value. You can repossess it and sell it for 50 cents on the dollar. But a GPU is technology hardware.
Yes. And we know the life cycle for high-performance AI compute right now is ruthless. We're talking 12 to 18 months.
Which is incredibly fast.
It is. And that is why investor Mike Burry, the guy famous for predicting the 2008 crash, has issued such a stark warning about this current dynamic.
What's he seeing?
He's analyzing the secondary market pricing of these chips. If you buy a state-of-the-art NVIDIA H100 GPU today, you are almost immediately competing against the newer Blackwell architecture, which offers massive multiples of inference performance.
And right behind Blackwell is the Rubin architecture.
Exactly.
Let me stop you there because I want to make sure I'm wrapping my head around the mathematics of this risk. Let's say I'm an investor looking at that AAA senior tranche of a CCO.
Okay.
The rating agency tells me it's safe because, well, in the event the AI startup defaults, the SPV can just repossess the GPUs and sell them on the secondary market. And the current financial models, the ones stamping that AAA rating on the debt, assume a 60% recovery rate on the hardware.
Yeah, that's the industry standard assumption right now.
But wait, if the collateral literally becomes obsolete garbage in 18 months, how can Wall Street slap a AAA rating on it? I mean, if a new chip architecture comes out that is 30 times more efficient, why would anyone buy a massive cluster of obsolete chips for 60 cents on the dollar?
They wouldn't.
Because it's not just that the old chip is slower. It's the physics of the data center. The old chip requires immense amounts of electricity and liquid cooling just to produce a fraction of the compute.
Right.
If the tokens generated by the old chip can't even cover the power bill to run it, its intrinsic value isn't 60%. It's zero. It's literally e-waste.
You've just identified the catastrophic model risk that Wall Street is currently ignoring. I mean, the rating agencies are taking historical recovery data from completely different asset classes, like telecom equipment or, traditional enterprise servers, and blindly applying it to the most volatile, rapidly depreciating silicon in human history.
That is wild.
It really is. In a true market distress event, or an AI winter where foundational model training slows down, the secondary market for 2-year-old GPUs wouldn't experience a gentle 40% haircut. It would freeze entirely. The recovery rate drops to near zero.
Because it's fundamentally incompatible with the new software frameworks being developed. It's
Yeah.
like trying to run a modern operating system on a floppy disk drive.
Precisely. And there is an additional layer of fragility here that didn't even exist in 2008, which is vendor concentration.
Right.
With subprime mortgages, the bad debt was at least geographically distributed across different housing markets, Florida, Nevada, California. But with CCOs, the sources indicate that upwards of 70% of the underlying collateral across the entire industry relies on hardware from a single vendor,
NVIDIA.
NVIDIA.
That's a massive single-point failure vulnerability.
It's unprecedented. I mean, if there is a localized manufacturing defect in the next generation of chips, or a sudden geopolitical shock to the supply chain in Taiwan, or an unforeseen antitrust action, it doesn't just impact NVIDIA's equity price. It instantly structurally devalues the collateral backing tens of billions of dollars of structured debt sitting in SPVs across the global banking system.
Okay, so we have these fragile, rapidly decaying assets bundled into shadow debt. And if one FPV goes bankrupt because of that obsolescence, those specific investors lose their money. I mean, that's capitalism.
Sure.
But a bad asset is a localized problem. Wall Street has a habit of turning localized problems into systemic ones. So how does a failure in a few data centers mutate into an economy-destroying contagion? What is the actual transmission mechanism?
The transmission mechanism is derivatives, specifically credit default swaps, or CDS. And the research outlines a highly complex 5-layer transmission channel that has rapidly evolved around this AI infrastructure.
Let's walk through those layers, because this is where the financial engineering gets incredibly opaque. Our listeners know the basics of a derivative, but how are they layering these specifically for compute?
Well, layer 1 is standard corporate CDS. This is an institution buying credit protection against a massive hyperscaler defaulting on its corporate debt.
Okay, pretty standard.
Right. Layer 2 gets more specific. That's asset-backed protection. This is where investors buy CDS, specifically ensuring the debt issued by those off-balance sheet SPVs we discussed earlier.
So hedging the shadow debt directly.
Yeah. Then layer 3 is tranche protection. Let's say a hedge fund in London owns the mezzanine layer of a specific CCO. They like the yield, but they want to hedge the downside risk of the AI startup going under.
So they buy a CDS contract that only pays out if that specific mezzanine tranche takes a loss.
Exactly. Then you have layer 4, which is portfolio protection. Major banks will create bespoke baskets of different compute providers and data center SPVs and sell a single insurance policy on the aggregate default rate of that entire basket.
Okay, so far, these first 4 layers sound like relatively standard, albeit complex, risk hedging. You own an asset or you have exposure to a company and you buy an insurance policy on it. But it's the 5th layer where things historically go off the rails, isn't it?
Oh, absolutely. Layer 5 is synthetic exposure, and this is the accelerant. This involves creating entirely new structured notes and trading positions based purely on the performance of a reference portfolio of CCOs, without anyone involved actually needing to own the physical GPUs or the original debt.
Oh, man. This is the naked CDS.
Exactly. And this is vital to understand. A naked CDS is when an investor buys an insurance policy against a CCO defaulting, but they have zero actual exposure to the asset.
You don't own the data center.
They don't own the CCO tranche. They are simply placing a massive leveraged speculative bet that the underlying AI hardware will become economically unviable and the debt will fail.
So a naked CDS is just a put option on the AI infrastructure market?
Not quite. A put option is a bet on the direction of an equity price. A naked CDS is a bet on the complete structural failure of the debt itself.
Right. It's the difference between betting a company's stock will go down 10% versus buying a massive insurance policy on a stranger's house, hoping it burns to the ground so you can collect the payout.
And this is exactly the dynamic that caused the AIG bailout in 2008. They wrote hundreds of billions of dollars in CDS protection for hedge funds who were shorting the housing market. When the mortgages failed, AIG didn't have the capital to pay out all those speculative bets, and the entire system locked up.
Exactly the same dynamic.
But let me push back on this for a second. If a hedge fund is buying a massive naked CDS on a hyperscaler or a major GPU cloud provider, hoping their AI bets fail, doesn't that at least offer a clear pricing signal to the market? Like, it tells us smart money is betting against the bubble.
You would think so, yeah. But the sources highlight a critical mathematical vulnerability in how these trades are structured, called basis risk. And basis risk obscures those signals entirely.
Break down the mechanics of basis risk for me. Like, use a hypothetical.
Okay, imagine you're a macro hedge fund manager.
Okay, I'm the manager. You look at the 18-month obsolescence cycle of GPUs, and you decide the AI bubble is going to pop. So you buy a massive CDS contract to short one of the giant hyperscaler parent companies. You think you are perfectly hedged against an AI downturn.
Right.
But remember the shadow borrowing. The specific CCOs that are vulnerable to GPU obsolescence aren't on the hyperscaler's balance sheet. They are legally siloed in those SPVs.
Right. The SPV owns the actual depreciating hardware.
So the AI winter hits. GPU rental prices collapse. The AI startups default on their cloud contracts. The SPV suddenly finds itself holding $1 billion of obsolete hardware it can't lease out, and it goes bankrupt. The investors in that specific CCO are wiped out.
Ouch.
But the hyperscaler parent company, they just walk away from the lease. Their main balance sheet is insulated. They have massive revenue streams from enterprise software or advertising. They remain perfectly solvent. And their corporate debt doesn't trigger a default event.
Oh, wow. So your CDS on the corporate parent doesn't pay out a dime.
Not a dime.
You were 100% correct about the macroeconomic event like the AI hardware crash happened exactly as you predicted, but your financial instrument completely failed to protect you because the risk was siloed. That mismatch between the hedge and the actual failure point is basis risk.
Exactly. And this brings us to the most profound systemic risk outlined in these reports. It's the concept of capitalized interconnectivity.
What does that mean in practice?
The true danger isn't just that the tech depreciates fast or that SPVs are opaque. It's that the entire global financial system is currently capitalizing the exact same underlying growth expectation multiple times across totally different instruments.
So they're double counting the hype.
Quadruple counting it, really.
Yeah.
Think about the stack of capital resting on a single NVIDIA H100 chip inside a data center. You have the equity value of the AI software startup writing the LLM. You have the debt value of the CCO tranche financing the chip. You have the 15-year real estate lease on the building housing the chip.
Yeah.
You have the derivative CDS contract insuring the debt. These are all completely separate, multi-billion-dollar financial markets. But every single one of them is mathematically tethered to the singular foundational assumption that AI compute demand and token generation will continue to grow exponentially forever.
They look diversified on a spreadsheet because one is equity, one is real estate, one is structured debt, and one is a derivative. But they aren't diversified at all. They are all tethered to the exact same balloon.
Yes, exactly.
So if AI token demand drops or hyperscalers cut CapEx by just 20%, does this entire interconnected house of cards start to wobble? How are the brightest quantitative analysts and financial engineers on Wall Street missing this?
They are missing it because the very algorithms they use to model the risk are structurally incapable of seeing the environment they are operating in. Which brings us to the exact reason Wall Street's models are blind to the danger and introducing the core engineering flaw at the heart of this entire crisis. This is where we get into the groundbreaking work of Dr. Yogesh Malhotra.
This is where the story shifts from financial plumbing to the actual mathematics of artificial intelligence. We are moving beyond the CCOs themselves to examine the intelligence that governs them. So, who is Dr. Yogesh Malhotra, and why is his framework the key to untangling this mess?
Dr. Eng Professor Yogesh Malhotra is widely recognized in these sources as a singular post-AI quantum pioneer. His background is deeply cross-disciplinary, spanning MIT, Princeton, Silicon Valley, Wall Street quantitative finance, and the Pentagon.
Serious resume.
Very serious. And his central thesis provides a devastating mathematical critique of how risk is currently calculated. He argues that Wall Street, the rating agencies, and the hyperscalers themselves are all relying on what he terms backward AI.
Backward AI. That implies a fundamental architectural flaw. When he's a backward AI, what specific technologies is he referring to?
He is referring to the legacy technologies that currently dominate the market. Generative AI, large language models, and crucially, the underlying reinforcement learning algorithms that train them, specifically things like stochastic gradient descent and backpropagation.
So basically, all the stuff that is currently driving this $1.25 trillion boom, the very algorithms the CCOs are being issued to finance, what does he call them backward?
Because of how they mechanically function. Stochastic gradient descent and backpropagation are algorithms designed to minimize error by calculating the difference between an output and a known historical target, and then propagating that error backward through the neural network to adjust the weights.
Okay.
They are strictly based on historical data, statistical correlation, and pattern matching. They train on massive static data sets of the past, identify the statistical correlations, and use those to predict the next token, or, in finance, the next default rate.
Okay, let me translate this for the listener with an analogy.
Yeah.
Using backward AI to model the risk of these highly volatile CCOs is like trying to navigate a high-speed Formula One race by only looking in the rearview mirror.
That is a brilliant way to phrase it.
It works great on a straight, predictable highway, right? But the moment there's a hairpin turn or a totally new chip architecture, you crash. The models are, as Dr. Malhotra says, quote, predictably designed to fail, because its historical training data has zero precedent for what is happening.
That is an incredibly accurate metaphor for what Dr. Malhotra is describing. He explicitly states that these legacy GenAI and LLMs struggle with black swan disruptions, regime changes, and radical discontinuity. And to understand the mathematics of why they fail, we have to look at a concept he integrates deeply into his framework, which is Knightian uncertainty.
Knightian uncertainty, named after Frank H. Knight, right? I've heard economists use that term, usually when they're trying to explain why their forecasts were spectacularly wrong.
Right.
But let's break down the actual definition.
Right. Knight was an economist from the 1920s. He made a profound mathematical distinction between two concepts that modern finance constantly confuses. Those are measurable risk and unmeasurable uncertainty.
Okay, distinguish those for me mechanically.
Measurable risk exists when you do not know the specific outcome of a future event, but you know the underlying distribution of all possible probabilities. A roulette wheel is the classic example of measurable risk.
Okay, you don't know if the next spin will be red or black.
Right. But you know with absolute mathematical certainty that there are 18 red slots, 18 black slots, and 2 green slots. The parameters of the game are closed, static, and knowable. Because of that, you can use historical data to mathematically model the risk perfectly.
Right. Casinos don't gamble. They use measurable risk, and over millions of spins, the historical distribution guarantees the house wins.
Exactly. Now, compare that to unmeasurable uncertainty, Knightian uncertainty. This occurs when you don't even know the parameters of the game you are playing. You don't know all the possible outcomes, and you certainly don't know the probability distributions of those outcomes because the environment is entirely novel, dynamic, and actively adversarial.
So, trying to model the 18-month depreciation curve of a brand new AI microchip, when the software it's supposed to run hasn't even been invented yet, and a competitor might release a completely disruptive architecture tomorrow, that's not measurable risk.
Not at all.
That's Knightian uncertainty. You don't know how many slots are on the roulette wheel or if someone is about to swap the wheel for a deck of cards.
Precisely. And this is the core engineering flaw. Wall Street rating agencies are taking an environment defined by Knightian uncertainty, the chaotic, adversarial, rapid obsolescence of the AI infrastructure boom, and they are actively shoving it into backward AI models that were exclusively designed for measurable risk.
They are taking models trained on the historical default rates of 30-year fixed-rate corporate bonds and applying them to 18-month silicon life cycles.
Yes, because they are looking at the historical data of the last 2 years. During the initial ChatGPT boom, GPUs were incredibly scarce, and their secondary market value held up because everyone was panic buying compute.
And the backward AI ingests that recent historical correlation, assumes GPU scarcity is a permanent mathematical law of nature, and spits out a AAA rating for the CCO.
Yes. Backward AI excels when the future closely resembles the past, when training distributions remain stable, and when the boundaries of the system are fixed. But the AI infrastructure build-out is the antithesis of a stable system. It is an environment of true, dynamic, and adversarial uncertainty.
You have black swan technological disruptions happening constantly.
Right, and regime changes in monetary policy affecting capital costs and geopolitical supply chain shocks. So relying on historical patterns for multi-billion-dollar AAA ratings is mathematically flawed. The patterns trail reality by decades.
So when a pension fund buys $1 billion of that senior CCO tranche, relying on those correlation models and that 60% recovery rate assumption, it's fundamentally flawed from the ground up. The quantitative models aren't just slightly inaccurate, they are structurally blind.
That is Dr. Malhotra's critique in a nutshell. By relying on historical statistical patterns, the financial system is engineering its own catastrophic failure.
Tearing down the old models is one thing, but how do we actually fix it? This leads to the paradigm shift. We have to move from backward AI to forward AI.
This is where Dr. Malhotra's framework moves from critique to a constructive, actionable solution. If backward AI is defined by historical correlation and predicting the past, forward AI is built fundamentally on causation, real-time adaptation, and what he calls the anticipation of surprise.
Anticipation of surprise. That almost sounds like a paradox. Mechanically, how does an algorithm anticipate a surprise that has no historical precedent?
You achieve it by fundamentally altering the architecture of the intelligence itself. Instead of just predicting the next token based on static past text, forward AI represents a shift toward human-centered meaning-making. It's about designing systems that can actively reason about emerging futures. And to operationalize this, Dr. Malhotra introduces the architecture of QASANs.
QASANs. QASANs. That stands for Quantum Augmented Self-Adaptive Networks. Break that down for me. We hear the word quantum thrown around a lot in tech marketing. What does a quantum augmented self-adaptive network actually do that a large language model cannot?
Well, it's critical to differentiate this from pure quantum hardware marketing. QANs represent a post-AI quantum future. I mean, current GenAI and LLMs are essentially massive static statistical weights. If the real-world data distribution shifts, the LLM is useless until it undergoes a massive energy-intensive retraining process.
From scratch?
Yes, from scratch. QA-SANs, however, are designed as self-adaptive complex systems. They utilize quantum-inspired probability modeling, meaning they can hold and continuously evaluate multiple conflicting states of uncertainty simultaneously.
So instead of settling on a single probabilistic output based on the past, they are constantly running adversarial simulations of the future. They rewrite their own logic in real time.
Exactly. They integrate principles of appreciative inquiry and real-time game theory to navigate environments characterized by adversarial dynamics. And in the financial context, this capability enables something revolutionary, which is model risk arbitrage.
Model risk arbitrage.
Yeah.
Let's unpack the mechanics of that. Arbitrage typically means exploiting a price inefficiency between two markets. You buy a commodity for $10 in London and instantly sell it for $11 in New York. How do you arbitrage model risk?
You do it by possessing a superior epistemic lens. You have the edge over traditional algorithms. Let's look at our CCO example. The rest of Wall Street is using backward AI. Their models are mathematically blind to sudden obsolescence shocks because they only look at historical correlations. Therefore, they systematically misprice the risk of the CCO.
Right. They think the AAA tranche is ironclad, so they price the yield very low, and they sell CDS insurance on it for pennies because their backward AI tells them it will never default.
Exactly. But if an institutional investor utilizes forward AI and QASNs, their system is actively anticipating that nation uncertainty. It doesn't just look at past default rates. It models the causal, mechanistic links between an upcoming NVIDIA architecture release, the thermal constraints of current data centers, the shifting economics of token generation, and the resulting secondary market liquidity for used silicon.
It sees the systemic vulnerabilities that the backward AI ignores.
Precisely. So the firm using forward AI can look at that exact same AAA-rated CCO and realize our causal modeling indicates the true secondary market recovery rate in 18 months will be 10%, not 60%. This instrument is mispriced, highly toxic debt. They avoid the landmine entirely, or they actively short the market while everyone else is euphoric. They provide the edge.
They're arbitraging the stupidity of the legacy models.
Yeah, and this highlights a profound shift in how enterprises must view AI. Currently, legacy GenAI is often treated as a massive, subsidized cost center. Companies are burning tens of millions of dollars on compute just to generate text summaries based on the past. Dr. Malhotra argues that implementing forward AI transforms the system from a cost center into a high-performance ROI engine. It actively secures future outcomes by successfully navigating the very uncertainty that destroys competitors.
But let me ask you this. If these QASANs and forward AI frameworks are decades ahead of current commercial LLMs, what does this mean for the listener whose company is currently pouring millions into legacy GenAI? Are they buying the equivalent of a flip phone right before the smartphone drops?
The sources strongly imply that they are stepping right into an obsolescence trap. The paradigm shift from data-driven prediction to outcomes-driven anticipation is already underway. If an organization's core risk management relies entirely on backward AI algorithms that are predictably designed to fail under dynamic stress, they are incredibly vulnerable. It's urgent that they pivot away from hype-driven backward AI.
Okay, which transitions perfectly into practical, actionable advice for navigating the current market. We've dissected the macroeconomic danger of the CCOs and the flaws of backward AI, but how do we survive this bubble? Let's move to the actionable strategies and look at the secondary winners.
This is vital because understanding the systemic risk doesn't mean you just exit the market entirely. The sources offer clear frameworks for both the bull and bear cases of the CCO market and specific strategies for capital allocation.
Let's start with the bull case. Is there a scenario where this financial innovation actually works as intended and doesn't trigger a crisis?
The bull case for CCOs requires a very specific and highly optimistic sequence of events. First, the macroeconomic demand for AI must not only continue but accelerate. We need hyperscaler capital expenditure to remain robust. Crucially, we need entirely new, highly profitable AI use cases to emerge rapidly and drive constant, insatiable compute consumption.
So the music has to keep playing, and the startups have to generate enough actual revenue to pay for the massive compute leases.
Right. If that euphoric demand holds, CCOs actually provide highly efficient capital allocation. In this perfect scenario, the secondary market for slightly older GPUs remains robust because there is so much demand for lower-tier inference tasks, and the senior tranches perform flawlessly.
But based on everything we've discussed regarding the silicon obsolescence factor and Nation uncertainty, relying on uninterrupted exponential growth is a fragile strategy. Walk me through the mechanics of the bear case. What triggers it?
The bear case doesn't even require a catastrophic collapse. It merely requires a deceleration. It triggers if hyperscalers decide to cut their capex by just 15 or 20%, or if we hit a mild macroeconomic recession that dries up venture capital funding for AI startups.
So the startups can't pay their cloud bills.
Exactly. The startups fail, which leads to immediate defaults on those SPV leases. Suddenly, you have a massive oversupply of used GPUs hitting the secondary market all at once.
And nobody wants them. The recovery rates on those repossessed GPUs plummet from 60% down to 10 or 15%.
Which instantly wipes out the equity and mezzanine tranches of the CCOs. The secondary market freezes entirely. The SPVs default. The CDS protection sellers are shit with billions in liabilities they can't cover. That triggers the contagion, and regulators force the major banks to bring all those shadow SPVs back onto their main balance sheets.
Which destroys their capital ratios, triggering a massive credit crunch. So, given those mechanics, what is the clear investment strategy here?
The immediate advice is unequivocal. Under no circumstances should you touch the equity tranches of these vehicles. Avoid them entirely. If an institution absolutely must allocate capital to this asset class, they must restrict themselves to the most senior AAA tranches, demand massive over-collateralization, and ensure the underlying leases are backed by investment-grade counterparties, not venture-backed startups.
But what if you want to invest in the AI build-out, but you refuse to play Russian roulette with rapidly depreciating silicon?
This is where the insights from Todd Alston, the Chief Investment Officer at Parnassus Investments, provide a brilliant alternative roadmap. From a Bloomberg interview cited in the sources, his strategy is to completely sidestep the circular financing and high beta risk of the tech hardware itself.
Where does he look instead?
He focuses entirely on the physical bottlenecks, the second and third order derivative winners. He looks at companies dealing with atoms, electrons, and energy rather than algorithms and silicon.
Give me the mechanics of that. What are the specific examples he points to?
He specifically highlights Vulcan Materials.
Vulcan Materials. They sell crushed stone, sand, and concrete. How is that an AI play?
Alston describes them as a toll booth on America's concrete. Before a single NVIDIA GPU is delivered, you have to dig a massive hole in the ground and pour tens of thousands of tons of concrete for the data center. Vulcan provides the foundational atoms, and crucially, concrete is not subject to a 12-month obsolescence cycle. Crushed stone doesn't experience Nician uncertainty.
That makes perfect sense. What's another example?
He points to Linde, the global multinational chemical company. They provide highly purified industrial gases.
What do data centers need with industrial gas?
These next-generation high-density compute clusters generate staggering amounts of heat. They require highly specialized, ultra-pure gases and liquid coolants for their advanced thermal management systems. Alston notes that Linde operates on incredibly robust 15-year take-or-pay commercial agreements.
Okay, let me synthesize this for everyone listening.
Yeah.
If you want to sleep well at night, you don't buy the rapidly decaying GPU. You buy the concrete hole in the ground it sits in and the specialized gas that keeps it from catching fire. You look for 15-year contracts, not 15-month lifespans.
Precisely. He also highlights companies like Hubble or GE Vernova, which manufacture the fundamental electrical infrastructure. These are bankable, long-duration assets that are completely insulated from the model risk of backward AI.
Now, beyond the investor, there is a massive mandate from macroeconomic policymakers here. What are the specific actions regulators must take to diffuse this?
3 non-negotiable regulatory actions. First, Mandate central clearing using CCPs for all credit default swaps related to CCOs. It forces the derivatives out of the shadow banking system. Second, enforce absolute transparency on off-balance sheet SPVs. Regulators must pierce the corporate veil.
And the third.
Implement realistic stress tests for the major banks. And the tests cannot simply model a generic collapse. They need to run stress tests based on a 30% growth deceleration, not just total collapse. If a systemically important bank cannot survive that mathematical scenario, regulators must drastically increase their capital reserve requirements immediately.
Wow. Okay, we have covered an immense, staggering amount of ground today.
We really have. We've moved from structured debt all the way to the mathematical foundations of artificial intelligence itself.
Let's recap the journey. You've explored the hidden machinery of the $1.25 trillion AI boom. You've uncovered the 2008-like dangers of collateralized compute obligations and naked CDS. And you've discovered how Dr. Yogesh Malhotra's forward AI and QSANs offer a map through Nietzschean uncertainty.
It is an incredibly complex web, but piercing through those layers is the only way to accurately navigate the risk.
Before we go, I want to leave you with one final, deeply provocative thought to ponder. We've spent this entire deep dive discussing human Wall Street engineers using legacy backward AI models to manage the financial risk of new AI hardware.
Right, humans are still running the models.
But what happens in a few years when agentic AI is autonomously trading these credit default swaps on its own underlying compute? If an autonomous forward AI realizes the legacy GenAI chips are obsolete, will it short its own hardware to maximize ROI, triggering the very silicon CDO crash we're worried about?
That is a terrifying and entirely plausible feedback loop.
Thank you for joining us on this deep dive. We encourage you to question the hype, look past the rearview mirror, and anticipate the surprise.